What a monster move in the last 24 hours. Live from New York City this morning. Good morning, good morning. That move continues, up a third of 1% on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, markets declaring victory in the fight against inflation. The House easing the risk of a government shutdown as President Biden meets with Xi in California. We begin with the big issue, a declaration of victory.
The Fed has been able to take the heat off of inflation.
Investors should be celebrating.
And essentially softer inflation prints.
Across the board, there's disinflation.
All of this points to a Fed that just does not need to be as restrictive.
The bar is high for another hike.
Really high.
I think the market reaction is a bit premature.
The Fed is not going to, take its applause and take a bow with just one data print.
They're going to stay pretty tough in holding their line against an early declaration of victory.
They don't want to declare victory yet.
They're very nervous about declaring victory and then having to undeclare victory.
They're really going to wait to see through really the first half of next year to make sure that the data continues to confirm that inflation will fall.
It will be on hold.
That period of pause has now begun.
We're going to win this thing.
We're going to win this thing. We're going to have that conversation right now with Evercore's Julian Emmanuel, Morgan Stanley's Vichy to the Patur. Julian, first to you. Are you ready to declare victory?
Look, we never want to declare victory on anything because when you get too overconfident in something, that's when markets turn around and beat you over the head. But the fact is whether it's turkey prices or gasoline prices or diamond prices, whatever, the trend of lower inflation, I don't want to say disinflation, but the trend of lower inflation is very much intact. And Ed Hyman has been talking about inflation with a 2% handle in 2024 for a number of months, and the market sees that that's going to be the reality.
Vichy, there is so much happy talk going around in the last 24 hours. Reality check from Andrew Hollenhorst over at Citi. Here's the quote. The reading does not change our view that underlying inflation is likely to remain stuck above 3%. In fact, the risk of sustained higher inflation rise with the re-loosening of financial conditions. Vichy, how do you look at things now?
We think that over the course of 2024, we will see inflation gradually come down. We might still be a shade above the target rate of 2%, the Fed's target core PCE rate of 2%. We might still not get there by the end of 2024, but the path towards getting there, we think it's pretty clear. So we will see economy slows. I think the Fed will maintain restrictive policy for perhaps the first half of the year, and we will start seeing cuts in the second half of the year and make substantial progress towards the target without actually getting to the 2% target in 2024.
Vichy, that's your view for next year. What do you think the bet is in this market right now? Is it that CPI can get to 2% without recession? Is it that these disinflationary trends are so powerful the Federal Reserve can go on an aggressive rate-cutting cycle? What do you think the bet is embedded in financial markets now?
I think that what the markets have priced in is a pretty smooth transition from the macro environment we're in into a smooth soft landing is very much in place pretty much across the asset classes, across various markets. In fact, that is, in our view, this smooth macro transition is the key to following here. Is there is very little room for error for markets. Markets are priced for this to already happen. Whether you look at credit markets, you look at the equity markets or elsewhere, this is very much in price, and there's not a lot of room for things to go wrong.
David Costin at Goldman saying the same thing. They're looking for 4,700 on the S&P 500 year end. Not in 2023, in 2024. And with this far away from it right now, we could well get there, Julian, before the end of the year based on a price action of yesterday. Their view is interesting, Julian. They're really constructive on growth in 2024. That's Jan Hatzius over at Goldman. David Costin on the equity side saying despite that, this view is already reflected in equity prices. How constructive Is the price action for you, Julian, after the moves we've seen in the last day?
Well, look, there is, again, no arguing with the price action. Price has been paramount. Frankly, since the moment that oil began falling in the wake of the Middle East conflict, contrary to everyone's expectation. But if you think about 2024, the challenges to economic growth we think are still there. Frankly, if you're not calling for a recession at all, and you think growth is going to be stronger, and you think the Fed is done hiking, certainly as we do, you should probably be thinking higher than 4,700. We think it's not going to be that smooth path. There are likely to be growth hiccups. You think of all the geopolitical challenges. You think of an election coming next year. You think about the fact that earnings themselves haven't grown in a year and a half. All of those mean the path is not smooth, but we do think that the scope for higher prices remains.
Julian, the moves yesterday, best down the S&P since April. Small caps, best day of the year so far. The Russell up by more than 5%. Real estate on the S&P, best day of the year so far. Julian, I think it's really important to reflect on the fact that this came off the back of a really small downside surprise on inflation. Julian, we often say on this program, many other people in the market say it too, you can learn something from the data, you can learn something from the way the market responds to that data. What did you learn yesterday from the way this market responded to a very small downside surprise on CPI?
The psychology around a number that printed 0.0, very, very profound in an environment where, look, think about it, in the small cap Russell 2000, we undercut the 2022 bear market lows 2.5 weeks ago. The most hated group of stocks, uninvestable, a smaller aggregate market cap than a number of the Magnificent Seven. All of these negatives feeding into the fact that now, if nothing else, talk of the Fed needing to raise its core PCE target from 2% to 3%, that's been retired. All of that fed into the positive.
Julian, the winners of yesterday, do you think they're the winners going into year end?
Well, again, if you look at last year, whether it's year end or thinking about the first quarter, there is an absolute strong reversion tendency. And we expect, as is normally the case, at some point between now and year end, the tax loss losers are going to outperform. They certainly did yesterday. And, multi-month, we do think that'll be the case.
We're still reflecting on the economic data of yesterday. We need to talk about the economic data of this morning. Let's get to Mike McKee for more. Morning, Mike.
Good morning, John. Another good day of economic data. Not quite as spectacular as yesterday, but we do see retail sales come in stronger than expected. The headline number drops 1/10, basically because gasoline prices fell. But the control group comes in up 2/10, about as expected, down from last month, but still showing that the consumer is out there spending. Remember, these are dollar-based numbers. So with the inflation numbers falling back, they're going to take something off the top of retail sales. PPI, look at that headline number, down 0.5%. We're 1.3% year over year. The core comes in up 0.3 for the month. It's now at 1 for the month, rather. It's now at 2.9% for the year. And the Empire Manufacturing Index turns around. So all the numbers pretty good this morning. Retail and control sales, as I was saying, are the kind of the key here for economists. And because retail sales were revised up in September, you combine the two and you get an 0.8 gain for the 2 months, which is fairly strong. And then control sales are up 0.9. Really good news overall for the economy, setting us up perhaps for a stronger fourth quarter than we had seen. The biggest takeaways: you got to do those combination average out numbers for revision because of the September sales strength. Gasoline sales were down 0.3. That's less than anticipated. But then you look over at producer prices, and gasoline prices fell 15.3% at the producer level. And that really pushed down on that headline producer price number. Goods prices were down 1.4%. Service prices were flat. In the CPI, service prices were up by 0.3. So perhaps some more disinflation coming. And John, the bottom line is we're where we were yesterday in terms of the Fed. Right now we've priced out any more rate cuts, and we're looking at now the first rate increase perhaps very close to May.
Mike McKee, thank you, sir. Bank of America, they say this: we now think the hiking cycle is over. Citi, additional rate hikes, very unlikely. We saw this captured yesterday in the fund manager survey out of B of A. 76% say the hiking cycle is over. I think if you ask people again after the print yesterday morning, that number's going to be higher. A record 61% expect lower yields. Just 6% see higher CPI in 2024. Vishy, based on what's expected right now, based on your forecast for the next 12 months, what is the biggest risk for you? Do we get a material slowdown in this economy, or this strength that we've seen through 2023 persists into 2024?
I think the latter of those two that you just said. If we see we are expecting that the economy will begin to slow down meaningfully without going into an outright recession, and if we are wrong, where I'm more worried about if we are wrong is that the strength of the economy persists, and the progress that we have made in the path of the trajectory of inflation that reverses. That's the biggest risk, and we think the everything we are looking at, the data from yesterday, the data from the labor, the non-farm payroll numbers a couple of weeks ago, and including the data, some of the PPI data today, all of that points to this transition in the direction we are expecting. We called for this to happen in our outlook that we published over the weekend, and I think the bigger risk, the risk for us, is that the slowing of the economy that we are expecting as a consequence of monetary policy remaining tight, restrictive for longer, that doesn't come through, and we see a stronger economy than what we've been hoping for.
Julian, do you agree?
We take a slightly different view here. Look, I think if we've learned anything in the last several months, it's that higher for longer is tolerable. Okay. And you're getting to the point in terms of thinking about the markets where the focus is going to move from inflation, from what the level of rates are, to growth. From our point of view, if you continue to have a reasonable growth, the Fed doesn't have to do anything. It can tolerate the financial conditions loosening, provided that inflation doesn't rekindle. And again, as I said earlier, we don't think that it does. But from our point of view, when you look at some of the inflections we've seen, look, yes, it is the unemployment rate, but it has inflected. What we're looking for is whether the actual jobless claims data start to accelerate. If that does, then we're going to, go back to this idea that the biggest risk is going to be a slowdown in the economy.
Interesting. More claims data coming tomorrow morning. This conversation is going to continue. Julian Emmanuel, Vishy Tripatur, about 20 minutes out from the opening bell. Equity futures here just about positive by 0.2% on the S&P. Let's get you some movers going into the open. Here's Abby.
Well, one stock that is certainly helping the slightly warmer open, John, is Target. I was about to say Target, because the Target feeling is back. They put up a massive beat, $2.10 in adjusted earnings, 42% better than expectations on about $25 billion worth of revenue. Comp sales down, but less than expected. Leaner inventory is a big piece of it, and this stock is on pace, I believe, for its best day since 2019. JD.com up 6.3%, the Chinese e-commerce company. Their sales numbers beat lowered expectations, anemic growth, but investors are taking it. It's less bad. And then Tesla up almost 1%, a continued catch-up trade from its 35% July to October drop over the last couple of days, John. This stock up nearly 20%, which these wild swings tend to be more about emotion than informed investing. But if you're long Tesla right now, some of that those investors might be liking that action.
Abby, thank you. Believe it or not, coming up, we've got some good news in Washington. Congress making strides to avoid a government shutdown.
We have broken the fever. We are not going to have a massive omnibus spending bill right before Christmas. That is a gift to the American people, because that is no way to legislate.
The House passing a stopgap funding bill. That conversation up next.
What we need to do is avoid the government shutdown. Why? Because that would unduly harm the American people. This allows us as conservatives to go into the fight on the next stages of this, to talk about real border changes, policies at the border, to close the southern border, to get it under control, to talk about the oversight that's necessary on additional Ukraine aid, to get Israel done if they don't do it as we beg them to do. All these other matters in the supplemental, that puts us in the policy discussion, and we'll have stringent fights on principle and philosophy and cuts as well.
It's a victory for House Speaker Mike Johnson. Lawmakers passing his stopgap funding plan, easing the risk of a government shutdown and giving Johnson until next year to negotiate annual spending. The bill now heads to the Senate. That chamber aiming to quickly send the legislation to President Biden, avoiding drama before Friday's deadline.
We would like to do it as soon as possible. Both McConnell and I want to avoid a shutdown, so getting this done, obviously, before Friday midnight. You know the Senate has lots of arcane rules, but McConnell and I are going to work together. We talked about this yesterday to get it done as quickly as possible.
Over in Washington, D.C., Katie Lyons joins us now. Morning, Kaylee.
Good morning, John. It's unclear just how quickly is possible, because what the Senator Chuck Schumer was alluding to there is the fact that in order to accelerate this in the Senate procedurally, it is going to require unanimous consent from all 100 senators. So that is potentially where there could be a hiccup in terms of timing. You already have one Republican, Senator Rand Paul of Kentucky, who has said he will not support this CR, will introduce his own. It's unclear if that means he's going to hold things up procedurally. But at the end of the day, John, it does seem like the Senate is set to pass in a bipartisan manner, just as the House did yesterday, this continuing resolution, and send it to President Biden's desk, where he is expected to sign it. And they do have some time to do this. The deadline, of course, is midnight Friday. Now, this continuing resolution essentially will just kick the can down the road to two different dates early next year, January 19th for one batch of funding and February 2nd for the other. The thing is, though, John, they are still going to have to, between now and then, reconcile the different priorities of a Democratic White House and Senate with a Republican-led House where hardline conservatives are pushing for deep spending cuts. They, of course, did not get that in this continuing resolution. It was clean, meaning it keeps funding levels steady. That's why you had more than 90 Republicans voting against the measure in the House yesterday. So that is going to be the difficult work ahead, actually trying to put together appropriations bills that can get buy-in from everyone here in Washington. That just means shutdown risk, theoretically, is punted until early next year. We could very well be looking at a January or February shutdown still. The other question is, because you do have those Republicans who voted against Mike Johnson, what becomes of his speakership? Of course, it was Kevin McCarthy earlier this year who was ousted because he passed a clean CR with Democratic support, which is exactly what we saw happen yesterday. It does seem like Johnson's going to be granted a little bit more grace, but that certainly is still something overhanging the Capitol. And then, of course, the other thing, John, is this continuing resolution doesn't include funding for Israel and Ukraine. What the path forward for that looks like, how border security measures may tie in, remains unclear, and the timeline also unclear this morning, John.
Kaylee, thank you. There is going to be a massive fight over spending in Washington, D.C. in the new year. Based on events of the last 24 hours on Capitol Hill, we hope not literally. Julian Emmanuel, Vishy Tripatur back with us for more. Vishy, let's look at the numbers out of Moody's that came out on Friday going into the weekend. Moody's sees federal interest payments relative to revenue rising to around 26% by 2033, from 9.7% in 2022. Vishy, how big is that fight going to be next year over spending?
I think we'll continue to see I would describe the dysfunctionality in Washington to last for longer, and I think that's something we just have to get used to. We have seen this movie many times so far. So I don't expect that challenge to be easily resolved, given the House, the political leadership in the House and the White House and the Senate being in the other party's hands. So I expect that to continue to be there. But I think to me the more important thing is, are we going to see a further fiscal spend? I think that's very unlikely. So I think what the markets are thinking about is we've already seen an expansion in the deficit. We have seen a lot of expectations of issuance required. A lot of that is now in price. So I think what we need to worry about is that incrementally, are we going to see greater issuance, greater need for issuance of treasuries? I don't think beyond what's already priced in, I don't see that happening. That makes us constructive on duration and constructive on the longer end of the yield curve.
Vishy, does it make you constructive on lower volatility in the bond market? The reason I bring this up is because we're having another decent, sizable move today. We're up by 7 or 8 basis points on a 10-year, 452, after a double-digit move yesterday across the curve, 2s out to 30s. Vishy, do you think we can leave some of this volatility behind next year? Do we have the ingredients to do so?
I think the ingredients are there, but how they actually play out is still, it's still to be determined. We expect the volatility to be lower next year, but the road is not going to be that smooth. We are going to see some bumps in the road, and I think that's the path ahead. I think where it really depends on how the growth and the inflation data pan out.
Julian, you're an equity guy, but I know many times this year it's felt like being at the mercy of the bond market. Do you think the correlation starts to flip the other way going into next year?
Well, that's really going to be a function of growth, John. But what I think is possible here is if you think about it, right? Well, first off, look at yesterday between the actual fisticuffs and the verbal fisticuffs in the halls of Congress. It's just an indication of what's to come. And again, whether you're the speaker or you're the rest of Congress, the battle to get something done in a bipartisan fashion is probably going to be as bloody, if not bloodier, than the one that brought down the previous speaker. All that having been said, once we know what the budget trajectory actually looks like, it's probably a recipe for fixed income volatility to start calming down. And all else equal, that tends to be a good thing for equity market volatility on balance.
Julian, it's good to get your view. Julian Emmanuel, Vishy Tripator to the two of you. Thank you. Coming up on this programme, the morning calls and later, Target absolutely surging on the back of a big earnings beat. That conversation still ahead with BlackRock's Marilyn Watson. That stock is flying. Equity futures doing OK after a monster day of gains yesterday on the S&P 500, the biggest day of gains since April. Equity futures this morning positive 0.2%. Equities positive here, just 0.2%, going into the open in about 5 minutes away. That's the price action. Let's get you some morning calls. Your first call from Cantor Fitzgerald, downgrading Bristol Myers to neutral, $55 price target, warning investors the stock is a value trap. Your second call from Bank of America, moving Netflix to its US One Focus list, adding shares to a collection of the firm's best investment ideas. And finally, JP Morgan upgrading VF Corp to neutral, highlighting an attractive valuation and improving margins. That stock is flying in the pre-market. It's up by a little more than 6%. Coming up, Target delivering blowout results, crushing quarterly profit and sales estimates. That conversation shortly with BlackRock's Marilyn Watson. Your opening bell is just around the corner. Disinflationary enthusiasm of the last 24 hours overwhelming, about 20 seconds away from the opening bell this morning. Good morning. Following the best day of gains on the S&P 500 since April, on a Russell, the small caps, the best day of the year. Futures this morning adding a little weight to that rally on the S&P, up by about 0.25%. There's your opening bell. Switch on the board and get to the bond market. Yields look like this on a 10-year, bouncing back this morning by 6 basis points. Yesterday, double-digit move lower across the curve, 2-year out to 30s, 450. 59 on a 10-year. Up, let's call it 6 basis points right now. The dollar, worst day of the year yesterday for the US dollar on the dollar index. This morning, trying to bounce back against the weaker euro, 108.51. That currency pair at the highest since late August in yesterday's session. The dollar weaker against absolutely everything yesterday in G10 this morning. Trying to make some kind of a comeback. Crude lower by 1.3%, $77 and about 24 cents. About 30 seconds into the session, state of play right now on the S&P 500. Up, let's call it 0.3 0.4% higher on the S&P and on the Nasdaq. One stock to watch at the open, Target, shares jumping higher on better than expected Q3 results, fueled by leaner inventories and fewer markdowns. Abby has the story. Hey, Abby.
Hey, John. Yeah, this stock is absolutely soaring, up more than 13%, heading right now to its best day since November of 2019. And there's big relief here for investors in Target, because this stock on the year into today down more than 25%. Really a combination of heavy inventories and weaker than expected demand, perhaps. Now we're seeing a bit of a reversal of that, or at least the company's learning how to manage this new environment, because CEO Brian Cornell just was talking about how it's still, they are cautious in the near term. They're saying that consumers are cutting back even on food, delaying purchases. But the good news is they beat earnings in such a big way by 42%, $2.10 in adjusted earnings, about $25 billion worth of revenue, basically in line. Comp sales were down, but less than expected, down 4.9%. And beauty is a bright spot. So again, I think that it is a matter of managing to learn the environment. As you mentioned, inventories down by about 14% year over year. Markdowns are less. And if we compare Target to Walmart today, right now, Walmart up nearly 20% on the year. Target, again, into today, down about 25%. I think that really speaks to the idea that Target's caught in this spot of the value proposition, but sort of that Target factor. It looks like they're learning how to manage that. The stock up 13%.
Big move higher for Target. Abby, thank you. Target up by close to 14%. Would be, just to reiterate some of that, biggest day of gains going back to November 2019. So 4 years. Big day for retailers tomorrow. You'll hear from Macy's, you'll hear from Walmart, you'll hear from The Gap as well. We'll be on top of that for you. Just to turn to our reporting from Ed Ludlow here at Bloomberg on SpaceX, discussing an IPO for its Starlink satellite business as soon as next year in order to capitalize on robust demand. I'm pleased to say that Ed's jumped in front of a camera for us now. Ed, what's the latest?
Yeah, so sources say that the end of 2024 is possible, noting that it's also an election period, right? And then if not the end of 2024, 2025. The idea of Starlink being spun off is something that Elon Musk and Gwynne Shotwell, who's the president of SpaceX, have discussed in the past. What's changed is just that the business has such momentum. We reported a couple of weeks ago that next year Starlink revenues could be above $10 billion, meaning the majority of revenues overall from SpaceX, alongside the launch business. John, it's important to note that I'm hearing from one source that what SpaceX is doing is moving Starlink and Starlink's assets into a subsidiary, incorporating it as its own private entity, a wholly owned subsidiary of SpaceX, kind of a stepping stone towards that. But immediately following publication of our reporting and our story, Elon Musk tweeted or posted on X, the platform formerly known as Twitter, false. He was responding to a user who'd taken a screen grab of the story. So for transparency, there it is. Musk saying that this reporting is false, but that's what we understand from our Bloomberg sources.
Ed, interesting reporting, sir. Looking forward to the coverage a little bit later on Bloomberg Technology at midday in a few hours' time alongside Caroline Hyde. I want to check in on shares of NVIDIA. NVIDIA right now is slightly negative by 0.1%. You have to think about where we've been. We've had 10 days of gains on this name. And think about what we generated in terms of gains over those 10 days. Over those 10 days, the stock was up by more than 20%. We're talking about $200 billion plus in market cap added to this company. This morning, just slightly negative. Let's see if we can make it day 11 as it flips positive just briefly. Turning to the auto space, Advanced Auto Parts slashing its annual profit forecast and launching a $150 million cost reduction plan. Simone Foxman on top of this one. Hey, Simone.
Hey, John, this is actually the third cut to the fiscal 2023 guidance for Advanced Auto Parts retailer here, and a big one. Now sees EPS at $1.40 to $1.80, had previously, just as recently as August, seen $4.50 to $5.10 earnings per share. The estimate was $4.64. Third quarter, a little bit more mixed results. Sales beating expectations slightly, but margins really under pressure. Some 36% versus an estimated 43%. As you mentioned, announcing that $150 million cost-cutting plan, as well as the divestiture of Worldpac, a wholesale business, as well as its Canadian business lines, as it really pushes into the big box space. Also announcing a new CFO, Ryan Grimsland, will join from Lowe's. This is after we got a new CEO for the company, Shane O'Kelly, coming in September as part of a strategic review. RBC analyst says, there are some positives here. This cost cutting, the CFO, the divestiture plans, these are all steps in the right direction. But Stephen Shemish also writing that we suspect investors will tread with caution given several false starts in the past. We are seeing that caution reflected in the market this morning with shares down well over 6%, John.
54.69. Simone, thanks for that. I said it was a big day, big 24 hours for the retailers. We had retail sales out a little bit earlier this morning. That came in better than expected. We had numbers from Target. That stock is absolutely flying. Tomorrow, you'll hear from Walmart, you'll hear from Macy's, you'll hear from The Gap as well. We also heard from TJX this morning, topping Q3 earnings estimates, but delivering a profit warning for the holiday shopping season. Katie Greifeld has this story. Hey, Katie.
Yeah, it is a rocky morning for TJX. Of course, we're talking about the parent company of TJ Maxx and Home Goods. And like you laid out, it's a similar story to what we've been hearing this earnings season. It was a pretty solid last quarter, but looking at the guidance, definitely a bit soft there. In TJX's case, the off-price retailer posted third quarter earnings of $1.03 per share. That was actually a beat. The consensus was for 99 cents a share. But looking forward, TJX said it expects comparable store sales growth to be between 3% and 4%, with EPS in a range of $1.07 to $1.10. So that comp stores forecast actually beat estimate, but you take a look at what analysts are looking for EPS. The estimate there is for $1.12, so a bit soft on that metric. You did hear from the CEO saying that TJX strongly positioned heading into the holidays. Of course, a crucial period for TJX and pretty much every other retailer, but you take a look at shares this morning, currently off by more than 3%.
Katie, thank you. About 7 minutes into this session, I have to say this is quiet relative to yesterday, where everything was just absolutely flying. The S&P 500 is up by, let's call it a third of 1%. On the Nasdaq, we're higher by almost a half of 1%. In the bond market, just reversing some of yesterday's moves. Yields aggressively lower. 2-year out to the 30-year bond this morning, just a little bit higher, up by about 5 basis points on a 2-year maturity. On a 10-year, higher by 6. Let's call it 4.51. BlackRock's Marilyn Watson weighing in on the Fed's road ahead, writing this: while the Fed could remain in wait-and-see mode, we believe it's still unlikely they reduce rates anytime soon. Marilyn, I'm pleased to say, joins us right now for more. Marilyn, let's go to where things are at currently and where you expect them to be in 6 months' time. We've got inflation back to something like 3 to 4%, unemployment just south of 4%, and GDP in 3Q close to 5%. As you look at 6 months, Marilyn, where do you think those numbers are going to be?
Yeah, so we have, I would say, a relatively positive view on the US economy, and we certainly think that the data, as you mentioned, is continuing to show a very robust economy in terms of economic activity. But we're also seeing the progress in terms of inflation, start continuing to soften and come down a little bit. I think, however, it's still early days, and it's too soon to really tell that, we really are seeing inflation has been really in the trajectory that the Fed are looking to see. And I think also in terms of the economy, I think when you're looking at the labour market, when you look at the strong GDP growth, and you're seeing a massive, dispersion now between the US and other regions such as, the Eurozone, then, I do think that we're going to continue to see, pretty strong market. But, it's still too early to tell. We still have a lot of data to come through. And even looking at yesterday's data, a large number of components are still showing quite a lot of volatility. So, things such as shelter in terms of rental, that remains pretty sticky and elevated, energy and other things as well. So I would say, we're still, in a pretty uncertain phase. I think that's why the Fed is definitely probably watching and seeing. We're still continuing to see the impact of all the hikes that they've already implemented over the past 18 months or so feeding through. And now I think we're just starting to see the economy settle a little bit. We're starting to see really where it's starting to shake down. But I think overall we have a pretty positive view of the US.
Citi's Andrew Hollenhorst said this morning: underlying inflation is likely to remain stuck above 3%. Marilyn, given what you just said, do you agree with that?
So we do think it's continuing to soften, but I think it is too soon to say that it has been sort of brought under control and is coming down to the Fed's target of 2%. And there are a number of factors, as I mentioned, some including energy, some including the very sticky, housing market, shelter, things like that. We've also seen a lot of prices and inflation coming down in areas such as goods, in used cars, for example, and a lot of that may be already out of the numbers now. So I think there's still, a lot of volatility in the numbers, and we're still continuing to actually see the impact of the Fed hikes, but also of issues in the Middle East, of the impact of high energy costs and things like that. So it could remain above the Fed's target of 2% for some time.
Let's push that through the bond market then. So up until recently, we had a 2-year at about 5.25. A 10-year broke through 5% very briefly. The 2-year right now is at 4.89. The 10 years back to about 4.52. If you had to take a best guess of where the next 50 basis points would it be for higher yields, Marilyn, or lower yields?
So I think, at the moment, I think the moves that we've seen recently suggest that obviously the market is expecting the Fed to remain on hold in December and to pause. I mean, and so we are seeing a lot of volatility, and you have two conflicting sides to this. So on the one hand, you do have a huge amount of issuance coming through in treasuries, and we saw, for example, the weak 30-year auction last week. On the other hand, we do see the improvement in terms of the CPI data and other things. So you do have these two different sort of conflicting forces at work. So I think we're going to see volatility around these numbers, and it could actually go either way. But I think just given the huge amount of issuance, the fact that maybe some of the demand also for treasuries is dwindling a little bit, even as we see this increased supply, then it's really difficult to tell.
I think this is really, really important, though, that it doesn't change. Those things that you've explained don't change with the economic data that we got yesterday. We had this conversation with Vishitra Patur of Morgan Stanley about 20 minutes ago, Marilyn. This stock market wants to rally. I think what a lot of equity bulls would like right now is just for the bond market to stay out of the way. But as you've just explained, that volatility, Marilyn, might be here to stay. How unusual is this volatility in fixed income relative to what we saw pre-pandemic?
So pre-pandemic was also a very unique environment in that we'd had several years of monetary policy suppression, essentially. We saw effectively, rates come down and down and down. We had seen QE already implemented, years before the pandemic. And so we'd already seen years and years of really some of the volatility being taken out of the market by the fact that you had these backstop buyers, by the fact that you had, rates and spreads, really decreasing as well. And so volatility had been pretty low for a while, given all those factors. Then obviously you had the pandemic, you had, a huge spike in volatility. You had the unprecedented response from the Fed and other central banks as well, and governments as well. And now that we've seen rates hike again, and we're seeing them at, pretty aggressive levels from where they were 18 months ago, then volatility has increased a lot, as you say. We're seeing a lot more dispersion between the price of individual bonds. And so I think it is natural for maybe bond yields to be, more volatile than you would have seen in the era just prior to the pandemic, given all the monetary policy suppression that we had then. Volatility is likely to come down a little bit because it has been very elevated this year as the market really digested all these aggressive rate hikes from the various different central banks. But some level of volatility, I think, is to be expected. And certainly, I think some of the factors prior to the pandemic are no longer there today.
It's been a crazy volatile few months, that's for sure. And it may well continue. Marilyn, thank you. Marilyn Watson there of BlackRock.
Thank you.
Thanks for the update. Appreciate it. Equities right now about 14 minutes into the session, positive by 0.3% on the S&P. Similar move on the Nasdaq. Coming up later, the attention's going to turn to this. President Biden and China's Xi Jinping meeting in San Francisco.
We're not trying to decouple from China. What we're trying to do is change the relationship for the better.
Team coverage up next.
We're not trying to decouple from China. What we're trying to do is change the relationship for the better. From my perspective, if in fact the Chinese people who are in trouble right now economically, if the average homeowner, if the average citizen in China was able to have a decent paying job, that benefits them and it benefits all of us. But I'm not going to continue to sustain the support for positions where if we want to invest in China, we have to turn over all our trade secrets.
Chinese President Xi Jinping arriving in San Francisco for a high-stakes meeting with President Biden during his first trip to the U.S. in 6 years. The leaders scheduled to meet at 11 a.m. local time. The bilat expected to cover key issues, including economic competition, military communication, artificial intelligence, and the status of Taiwan. But the hottest event of the week may be after hours. A number of U.S. executives and officials are expected to attend an exclusive dinner with Xi for a chance to air concerns and ambitions in a less formal setting. Your team coverage begins right now with Bloomberg's Katie Lyons in Washington, D.C. and AMH in San Francisco. Anne-Marie, let's begin with you. What can we expect later on today?
Well, Jonathan, the real deliverable of this meeting is the fact that these two men, President Biden and President Xi Jinping, the leaders of the world's two biggest economies, are actually sitting down and having this meeting. It is coming off of some very frosty tensions between Beijing and Washington. So that's really the key deliverable. And you heard it there from the president. He just wants to make sure he can have more of a correspondence with China, being able to pick up the phone if a conflict arises. Another priority for this administration, Jonathan, is in the same realm of communications, but for military to make sure that that dialogue can go back to pre-levels before Speaker Nancy Pelosi took that trip to Taiwan. That really was a downfall in these relationships. So that's really the low bar. And then, of course, Jonathan, the fact of the matter is both these individuals, President Biden going to an election year, wants to make sure he puts a lid on this relationship, set some roadmaps, and then Xi Jinping, Biden there spoke to it again, talking about the domestic economic issues at home. Yep. For him, it's going to be try to get any kind of economic future out of the United States, whether CEO or with Biden.
Kelly, that takes us to you. I think this is really important. How much of a charm offensive can we expect from the Chinese leader with corporate America?
Well, John, he's going to try to convey the message that China is indeed open for business after there has been a lot of conversation in recent years about China being a market that is uninvestable. This is something that has been echoed even by the Commerce Secretary, Gina Raimondo. Now, we know this CEO summit is taking place on the sidelines of APEC. A number of well-known business leaders will be there, including Satya Nadella of Microsoft, Darren Wood of Exxon, Citi's chief executive Jane Fraser. Elon Musk will be there as well. It isn't exactly clear who has gotten this exclusive invitation to dine with Xi Jinping. I would just remind everyone that Jane Fraser and Elon Musk have actually made trips to China within the course of the last year. So that just speaks to the idea that a lot of these leaders are really trying to figure China out. It is the second largest economy in the world. It is a vital market in terms of demand for many businesses, a vital market in terms of supply chains for many others. And yet we know China hasn't always been ultra friendly to business at the moment. So that really is what a lot of this dialogue probably is going to be about. Xi Jinping trying to make the case that China is open for business, and these business leaders may be expressing what they might need to see from China and really what they would like to do in the Chinese market. I would just keep in mind one thing. This is a conversation, John, I was having with one of our geoeconomics analysts, Gerard DePippo, yesterday, this idea that while the administration is messaging that they have no desire to decouple from China, a lot of this decision-wise comes down to private actors in terms of economics. And if you look at trade flows, if you look at foreign direct investment flows, if you look at the flows of people like students and tourists, the U.S. and China economically are moving more apart than they are moving together. And that really is the backdrop as business leaders get set to meet with Xi Jinping tonight, John.
Katie, looking forward to the outcome of all of this. Kelly Lyons, Anne-Marie, MH, great work as well over the last 24 hours. This just feels like reaching for the thermostat and turning down the heat. Just a touch. That's what it feels like. Peter Chia of Academy Securities writing this. Be prepared for the meeting this week to come across as highly conciliatory, prompting an everything rally into year end. This is what Pete has to say. We don't even need to see concrete actions taken. If the messaging is strong, that messaging should be enough to get the job done. We're about 22 minutes into the session going into that meeting. We're positive by 0.2% on the S&P 500. Breaking things down to sector price action. Here's Abby.
Well, John, it is a relatively small gain, especially compared to yesterday's big rally, but that S&P 500 gain of about 0.2%. It is a broad-based gain because 10 of the 11 S&P 500 sectors are higher, led by consumer staples, real estate and utilities, those defensive sectors, those dividend-rich sectors. They are higher even with yields up. Healthcare is the one sector down. And then, John, John, I haven't said this in such a long time. If we take a look at the sector in focus today, if you will, the S&P 500 tech sector, well, it is at an all-time high. Its second record high in 2 days. One question could be, is this something to come for some of the other indexes? This is basically Apple and your chips. So it's talking about if we were to see more record highs for other indexes, a broadening out of what's happening for tech.
Abby, thank you. Up next on the programme, we'll take another peek at a calendar for the rest of this week. It's your trading diary. Up next. A little more than 25 minutes into the session, equities pushing higher by 0.2% on the S&P 500, following, of course, that blowout move yesterday. Big move on the S&P, biggest move since April of this year. That's the price action. Let's get to the trading diary. The week ahead shaping up as follows. The Senate potentially holding a vote on the stopgap funding bill later. Plus, President Biden meeting with President Xi at the APEC summit at 2 p.m. Eastern. Thursday, another round of jobless claims. Plus, earnings from Macy's, Walmart and The Gap. Full coverage of that tomorrow morning. And finally on Friday, it's the US government shutdown deadline expiring at midnight, and I think we all hope we can avoid it. From New York City, thank you for joining us. This was the countdown to the Open. Good luck for the rest of the trading day. This is Bloomberg.